Hello, this is Gary Schnicke from the University of Illinois, and today we are going to talk about opportunities and risks for 2022 and 2023, and we're going to do this from a Southern Illinois focus. What I plan on doing is giving a 2022 outlook. First, we're going to focus on fertilizers, and obviously fertilizers have been of interest with their large increases in cost here recently. We'll then talk about other costs, income, and then make suggestions for the coming year. After that, we're going to talk about beyond 2022, and in particular, focus on whether these cost increases that we saw this year are going to continue into 2023 and beyond. So that's our outline, and first we're going to talk about fertilizer. In the first part of January of 2022, AMS, Agricultural Marketing Service, reported the average price for anhydrous ammonia at $1,486 per ton. That is obviously very high, much higher than we've seen in recent years, but there is a bit of good news there. This is the first time that 1486, which was taken in the first part of January, it's the first time since the middle summer when that anhydrous ammonia price did not go up. So perhaps we've reached a high point in our increases on anhydrous ammonia. During the summer of this year, late summer, we were looking at $700 to $800 per ton, and some farmers purchased it at that point in time, wondered if they hadn't bought it too high, but we are at $1,400 now, and that $700 to $800 in the summer compares to $450-ish a year ago in summer and October. So we've had large increases on anhydrous ammonia. DAP and potash have increased as well. Last time we saw DAP prices from AMS, it was $853. That's first part of January price, $853 per ton for DAP, $806 for potash. Obviously, those prices then lead to much higher fertilizer cost per acre. And to look at that, we calculated fertilizer cost per acre using October prices and October prices last year, October 22, 2020, and then compared it to October of 2021. If we use last year's prices, $432 for anhydrous ammonia, and $428 for DAP, $327 for potash, we come up with $94 of cost using last year prices and replacement requirements for DAP and potash and anhydrous ammonia applied at the MRTN. For soybeans, the cost was $46 per acre. We look at those costs now using $1,400 per ton, and those more recent prices, we come up with $232 of cost for corn, $106 could cost for soybeans, $138 increase for corn, and $60 for soybeans. Obviously, those are large cost increases. As we're looking at anhydrous ammonia, and here we're looking at the anhydrous ammonia price that I showed on the previous slide. It's alone here. We're going to show that relationship between anhydrous ammonia and a couple other price series. The first is natural gas. Natural gas is a major ingredient, cost ingredient of producing anhydrous ammonia. And here you see natural gas prices at Henry Hub, and compare those to anhydrous ammonia. You will note that natural gas prices increased in recent months, and so did anhydrous ammonia. There is a correlation between natural gas prices and anhydrous ammonia. We're also going to show here corn, dollars per bushel. This is a national price, and you will also note that anhydrous ammonia is highly related to corn price, and it has a correlation with corn price. Based on that, we developed a model, very simple model of what anhydrous ammonia price will look like. And that statistical model, regression model, included lagged ammonia price, corn price, and natural gas price. We look at that model explains anhydrous ammonia prices well up to November 2021. And in that model, corn price has a larger role in an ammonia price, and it's more important It has more influence on ammonia price than natural gas. However, in November 2021, the $400 actual price was $400 over our predicted price. Just to give you a feel of what that looks like, this shows the predicted and actual price going back to 2008, and you see there at the end that our actual price is much higher than our predicted price, and if we just blow that in, we see that there's a 435 difference. There are a number of reasons that can be given for that much higher ammonia price in November than before, that $435 premium. Some of that relates to Hurricane Ida hitting Louisiana and the lower Mississippi basin and shuttering some plants for a while, so we had supply constraints. That could be part of the reason why we have higher anhydrous ammonia prices now. And in any case, we have $400 of premium built into spring prices, and our simple question often asked is what will happen as we move into spring? Will that $400 premium go away? If we see anhydrous ammonia prices at the price that they are today, there is going to be a large incentive to provide the product, as there's profit in moving that product. However, at this point in time, I would not expect to see large price declines before the time we have to apply nitrogen in spring and early summer, and we simply have to be thinking of high anhydrous ammonia and nitrogen fertilizer prices. Even if we didn't have that $400 premium now, given where corn price and natural gas price are, we would be looking at a anhydrous ammonia price of $1,000 to $1,100 per ton. We may see some retrenchments back to that point, but I would not count on it. There are other considerations going on here, and that is that there's very high production costs, natural gas in other countries, particularly Europe, as the Europe, Ukraine, Russia situation continues to develop. Given those high natural gas prices, fertilizer companies have some incentives to provide other parts of the world with nitrogen fertilizer. There are also countervailing duties in place as well. In any case, we are not looking at large price declines going into spring. So, what I suspect on the natural gas, corn, and soybean situation is that corn and soybean prices are going to be more tightly interweaved than usual. As we look at high anhydrous ammonia and nitrogen fertilizer cost, we can expect the margin, corn and soybean price, to widen so that there is an incentive to plant corn. The market needs corn, it needs soybeans, but it also needs corn, and the market will provide incentives for that production. If we are thinking of planting more soybeans, and that is a valid thing to do, you might want to price those additional soybeans. If you're doing that because of price, put the price in place. If we're going to be buying expensive nitrogen now, let's price that corn. Part of the reason for doing that now is because if we're looking at prices in late January, there is profitability for both corn and soybean production. I would also suggest pricing more than usual of the 2022 crop because in late January, the prices would suggest profitable production, given usual yields. So what are some other strategies for nitrogen? One of the things that can be thought about is reducing rates. Here are the rates stated in actual N per acre. These bars are given for southern Illinois in the red. Orange gives central Illinois, but you can see we go from a 239-pound rate at $400 per ton. If we're at a $1,400 price per ton, we're at 178 pounds. Those are MRTN rates. They come from the MRTN generator that is maintained by corn N rate generator maintained by Midwest states, with Illinois contributing data and Emerson Knapsinger being behind those. In any case, if we reduce nitrogen applications, we will likely see some decline in yield in some years. But you have to remember, we're putting on much higher priced nitrogen. Second strategy is to split applications. And I might suggest applying 75 of MRTN before planting and then apply the remaining after planting. See what happens. See where prices are at that point if we haven't locked them in, and see where we're going. This is a classic risk management strategy. Price it at several points in the year. Finally, and another strategy is to apply most nitrogen as anhydrous ammonia. Anhydrous ammonia almost always is the lower cost way of applying nitrogen, and as we're moving into spring, it will most likely be less costly on an actual N basis than 28%. So those are particularly important in high price fertilizer price years. We're also going to likely see pesticide issues moving into spring. Glyphosate and glyphosate supply issues will continue. Those are built around COVID-related concerns, China and production of those basic ingredients in China, getting them over from China to the United States, and the container issue, and then Hurricane Ida, causing the closing of some plants. I would expect large increases in price, but I would also expect most of our supply to be there, but we're likely have to reevaluate those pesticide programs in light of those large cost increases. And this is probably something that we need to do anyway, as we see more weeds becoming herbicide resistant. So what are we going to do in that situation? One of the things we might consider, and we know this is a joke, is to do more row cultivation. This is a row cultivator that we find. We know it's a joke because even if you wanted to do it, you couldn't find the piece of equipment to do it and buy it by spring. So looking at our budgets, here is corn and soybeans. Southern Illinois budgets 190 bushel corn yield, 57 bushel soybean yields. We're using current fall bids in January, $5.25 for corn, $12.50 for soybeans. They're obviously vary day by day. We're using fertilizer cost based on $1,400 ammonia price. I would note that if we're doing this with UAN or 28 or 32%, those costs could be much higher. We built increases for pesticides, and we're going to come out with very high direct cost. But even given those high costs, we're still seeing corn more profitable than soybeans. So moving into this year, we're still projecting corn more profitable than soybeans. If we look at that, corn versus soybeans, we come out with a projection of corn being more profitable in 2021, same thing in 2022, and that differs from those years from 2014 through 2018 when soybeans were more profitable than corn. In the long run, we may need more soybean acres as we move forward, particularly if biodiesel takes off, but we have to look at those situations as they come up. We're also going to note that cash rents are going to increase a lot. We have on this chart average cash rents, and obviously some cash rents are much higher levels than we're showing here. We can find 300 plus, 400 plus cash rents on farmland. That might have worked last year, but the economics of that are different this year with these large cost increases. As we look at those cost increases, we come up with $735 of non-line cost per corn in Southern Illinois. Let's say our average cash rent is $188, and that will be specific to each farm situation. That would give us $923 of total cost, which is much higher than last year's $775, and that will be a record level of cost for putting in corn in Southern Illinois, and for that matter, any place in the United States. So $923 those high non-land cost and cash rents will raise our break even. we're coming up with break-evens of 496 for 2022. That 496 is based on average yield, so if yields vary from that, they will obviously vary from that as well. But 496 is very high break-even level. Currently, we have prices above that, but very small declines will result in losses. I would note that 496 is higher than any one that we had, except for 2012 when our yields were drought-stricken. If we subtract other revenue, which would be primarily crop insurance and commodity title payments, we see that 496 is much higher after we consider those. There's a similar story for soybeans. 488 is the non-line cost we're projecting, 188 cash rent, $676 of total cost for soybeans. Again, a record over $100 higher than last year, so we're raising the cost and raising the break-even. 1186. Again, we're looking at prices that are above that 1186 break-even at this point in time, but that break-even is higher than our average prices from 2013 through 2019. Just gives you a feel for where we are at. So, based on that, what are our income projections for 2022? Last year, we're projecting incomes on grain farms in FBFM all across Illinois to average $325,000. That's 2021. That's still a projection because FBFM is in its process of making its determinations or getting the records in. That $325,000 per farm, and that average farm size would be 1,500 acres. And we have farms in this average that are vary tremendously from that 1,500 acre average. Some of those farms are over 10,000 acres, and obviously we have some farms that are 500 acres and in that range. So large range in farm size in that average. 325 would be a record level. We would be projecting $130,000 at a $5 and $12 corn price. So down considerably from last year. And those are good prices, but down considerably, and the reason they're coming down is because of higher cost. If we have 480 corn price, 1050, $57,000 of net income. That $57,000 would be less than our average from 2013 through 2020 when we averaged right at $70,000 per farm. And then if we go back to that $4 corn price and $10 soybean price, we would be at a minus $65,000 of income. Obviously, that would be a very bad situation, and hopefully we don't see those situations arise, but it does point to the need to take risk protection. Here's our suggestions. First off, hedge more grain or price more grain now than you typically would. Not all of it, but more. And the reason why is there are prices out there that do offer profit. We could see much higher prices in the fall if we have any sort of supply disruptions. Short crop here in the United States would send those prices up. And in that case, you're hedging now. One of your protections would be RP insurance. We would suggest continuing to buy up on crop insurance. Most Illinois farmers buy at high coverage levels, 75%, 80%, typical in southern Illinois. We would suggest continuing to do that because if we do see price declines, we are at much higher cost. We would also suggest not changing rotations too much. Keep running what you've been running. In southern Illinois, that typically is more soybeans than corn. And see where that goes. Those longer run rotations probably are more important than chasing the profitability projections of one crop. We would see what nitrogen rates, lower those nitrogen rates because of the higher nitrogen prices, and rely more on post applications. Finally, let's just see what 2023 brings. 2022 could be a profitable year. but then look at 2023. Illinois farmers, and all farmers across the nation, have March 15th to change their ARC PLC choice. Most of farmers in southern Illinois probably took PLC for corn and wheat and ARC County for soybeans. You can make changes to those programs by March 15th. If you make changes, those are the payments that will be received in October 2023. We're looking at the ARC PLC choice. Neither option is likely to make a payment. If you want SCO, which is a supplemental coverage option, which is a crop insurance product, you will need to take PLC. I would personally lean towards PLC for corn and wheat, ARC County for soybeans, and the ARC County would be if you don't want to take SCO. Again, neither of those options are likely to make a payment. Our reference price is $3.70 for corn, $8.40 for soybeans, $5.50 for wheat. ARC County has the same benchmark price for corn and wheat, but higher for soybeans, and that's why I lean towards ARC County for soybeans. Again, we're looking at very low probability of any of those making a payment. All right. What happens beyond 2022? So we know we're going to have high costs. What happens beyond 2022? We are currently in the first part of 2022. We are in an expansion of the economy. Third quarter, GDP grows by 4.5%, which is above averages since 2000. And you can see that we had a negative minus 31% decline in GDP and as a result of COVID, then an increase, and now we're running at 4.5%. So our economy is expanding pretty well, and that has led to inflationary pressures. In addition, COVID has changed the way in which consumers buy goods, and it also causes more of a reliance on imports into this country. And one of the bottlenecks has been the Long Beach port. Long Beach has received more containers post-COVID than they did pre-COVID, and that has caused bottlenecks there. And that situation will get worked out over time, but it's going to take time as the capacity needed to move containers through there have increased. It just takes time for the supply chains to react and make the necessary changes to react to those changes. So COVID caused a need to readjust the supply chains. At the same time, COVID caused our unemployment rate to increase, and now it has declined. Last reading we had in December was 3.9%, which is almost the same as what it was before COVID, when it was 3.5%. So that 3.9%, very low unemployment rate, but there is one difference. We have a smaller workforce now. Our workforce last reading was 149 million workers. That compares to 153 before COVID. So while our employment rate has come down, our total number of employees has not increased to pre-COVID levels. And to be unemployed, you have to be looking for work. So what we've seen is a lot of people not looking for work. Those have included older generations who have retired, and another group that has exited the workforce is moms with school-age children. We will see if they come back, but one can expect that over time we are going to have a shortage of workers, at least compared to previous times. We at the same time have inflation. 7.1% was our last reading, and the central question is this transitory or is it permanent? 7.1 is the highest rate since going back to the 1980s. And part of the reason why that has happened is because of the supply disruptions, money being pumped into the economy, and those prices, those CPI or the goods we buy, have been increasing more than wages. So the question is this a transitory versus non-transitory inflation? I would point out one thing that happened last quarter of 2021. Deere had a strike, and to end the strike, the new contract has included increases in wages and a cost of living increase. That cost of living increase harkens back to the 1970s when we had another round of inflation, and COLAs, cost of living adjustment clauses, were prevalent. So building those cost of living increases into labor contracts is sort of a self-fulfilling contract. I would note that labor is short, and that is not likely to change anytime soon. So we will see continuing labor issues into the foreseeable future. Everyone, and that includes farmers, every time I talk to farmers, I hear of difficulty in getting full-time employees, and I also hear them having difficulties finding harvest-time employees, and that's not going to go away. We simply have a lower workforce, and that lower workforce will likely cause wages to increase, and that could lead to longer-term inflation. You can see that labor issues in the prices paid for tractors, which have gone up in the last 6 months of 2021. Part of that is due to those labor issues. Part of that also is farmers had very good incomes and were looking to buy equipment to shelter income from tax payments. In any case, we've seen tractor prices go up, and they're not likely to come down. So what is this impact on our current situation? I would suspect that we're going to see labor shortage into the foreseeable future, and that's not likely to change anytime soon. Everyone is looking for employees, and that will not change. So that is their new state of life. Seed will continue to increase. We've seen 8 to 10% increases, and that will likely increase in the future. Pesticide and equipment costs will continue to increase, but they're not, I would not suspect, going to decline from current levels. And fertilizers likely will come down in 2023. But note that what will likely cause fertilizer prices to come down are commodity prices coming down. So that may not be a good scenario. In any case, the market is thinking that there will be inflation in the future. We currently have 7.1%. We've seen our 10-year constant maturity treasury rate increase a bit, but 1.4%. And you can buy a 10-year treasury inflation-protected security for minus 0.99. The difference between that CMT and the inflation-protected is the market's estimate of inflation over the next several years, and they're coming at 2.4%, which is an increase from recent times. So the market is expecting inflation rates to moderate, but sort of in that 3.5% rate. So that would be an increase from what we've seen in recent years, and will be something that bears watching moving forward. What I expect, though, is that those inflation rates will not have an impact on nominal rates, because there's going to be large policy incentives to keep those policy or those nominal rates low. But I do expect to see inflation to continue and real rates decline. So an individual holding money in banks, you have to question what they're going to do, because if we have inflation rates above 3% and our nominal rate of return is 2%, we are eroding that money over time. Overall, I don't expect anything to change in markets, in farmland markets, until something dramatic happens, and who knows when that will be. So in summary, 2021 has a very good chance of being a profitable year, but less profitable than 2021. We might want to begin to think about taking risk protection. Costs will be high in 2022, but fertilizer prices may moderate into 2023. And overall, other costs will not decline until we see corn and soybean prices decline. I appreciate your time today. Thank you for listening to this video. And again, 2023, 2022 could be a profitable year, so let's take some risk protection.